Nothing said on 0x Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed.
Hey, welcome back to another live stream, 0x Research. Myself, joined by Boccaccio. The music's still going. We love the Feeding the Ducks song, man. It's just so catchy. Joined by Boccaccio today, as well as our very own Shaunda Devens from the Blockers Research team. How are we doing today, gentlemen?
Very good. Thank you for having me on, Danny.
Yeah, thanks for having me on as well, man.
Always glad to have you on, Boc. Same with Shaunda. I guess big topic we want to talk about today, obvious from the title. Boc, I'll maybe let you lead it in, but maybe all over the timeline, all over everyone's covering it, everyone's fighting over it. Take it away. Why do we have Shaunda
on? I guess before we get into equity perps, I kind of want to discuss something else, also related to Hyperliquid. I think if I tried to discuss anything about Hyperliquid with Shaunda, he would start freaking out. But they just announced cross portfolio margin. Did you see? Shaunda.
I just saw the update.
Yeah, what do you think about that? This is something Ryan has been really, really geeking out over. He's been saying it's because you can do this essentially on every other venue, right? Every TradFi venue, but it's not something that is done very efficiently within crypto. And on the Solana side, we saw Project Zero, which Danny, I can't remember if you were on that episode, or it might have just been me and Ryan.
I think I was not on that one.
Yeah, and it was that was their main value proposal, is allowing cross collateral. This is what the BLP, I guess, was being built out for. It's quite exciting to see that it's happening on Hyperliquid as well, because we obviously saw Solana have a relatively big equity announcement at Breakpoint with Ellipsis, announcing that they're going to be building out a Perps 6. I don't know if it's under Phoenix or not, but pretty exciting stuff. They haven't had success with perpetuals over on Solana. It's just the reality of the situation. Despite the fact that perpetuals generate a lot of money, and Solana is not built specifically for it, but is one of the few chains that is fast enough that it can support perpetuals. So it's going to be interesting to see. It's exciting to see Project Zero Plus. I assume they'll work together with Phoenix quite closely, although they do have different prop AMM teams. So it might be, because one is temporal and humidified, the other one is SolFi. It'll be interesting to see. But yeah, Jakob, unless you have any big takes on that, we can go directly into equity perps, where I start grilling you question by question. Or Danny, unless you have something.
I guess I'll add something real quick. I think the interesting piece there is that we haven't seen perps take off on Solana for a long time, but I was just chatting with our very own Carlos on the research team on Lightspeed the other day about prop AMMs could be that solution for them. It's kind of been a solution to do a lot more volume, provide a lot more liquidity to markets on full on-chain trading. So I think, that's basically what we're seeing here from SolFi team or Ellipsis Labs now doing Phoenix perp DEX rather than just a CLOP DEX. That seems like it really is maybe the answer or the solution to kind of scaling that business on Solana. So I think it's exciting. I think this is probably a real test here to see if now those markets can take off much more successfully than they have in the past.
Yeah. Jakob, any hot takes? Shaunda,
not really.
Up already. It's
the first name call was a fail. No, it's exciting, but I think it's expected, right? It's inevitable. I think I've just seen it, so I haven't really had time to look into it. But I think the carry trade is one thing that's super interesting to me, right? You can have a delta neutral position with your spot balances going short, stuff like that, being able to earn yield on your collateral. But probably more excited about the equities, to be honest.
Okay, then let's talk about equities. I have 3 questions for you to start us off. Number 1, where do you see the potential, apart from Hyperliquid, for equity perps to be successful? Like which platform or protocol and why compared to the others? And then the second one is I want to dive into how the oracles work. I expect that you don't have the perfect knowledge for this because you're not an oracle provider, and I also don't have it. So we'll give a cursory level glance at it, because from what I understand, that is the main difference between these, specifically between Felix and Trade XYZ, right? That's the main.
Yeah, like for the HIP3 ones, it's basically only the oracles that's going to be different, and the code asset, right? USDH and USDC. I guess there's going to be a third question as well, right?
I'll ask it later. Start off.
Okay. No, I mean, like, maybe it would be better. Like, I can definitely answer that. Maybe like give a bit of a pitch first, like why these equity perps are so interesting to me, especially when you think about the dominant instrument of like options, which is being used in TradFi. I think it's good, like, first to kind of contextualize these two like instruments, right, and their architecture. So what an option does, it allows you, if you buy a call, it allows you to basically buy that asset at a future date at the strike price that you lock in, right? So if you're bullish on Bitcoin as trading at like 100K, you could buy a call option to buy Bitcoin at 100K in like 6 months from now, right? So then even if Bitcoin's trading at $1 million, you can buy it for 100K, sell it for $1 million, and you lock in like 900K profit. And because of this leverage that these like options enable, it's been kind of the dominant tool that both institutions and retail use to trade over on TradFi for equities, indexes, anything like that. But they're actually like pretty sophisticated and complex products, right? Because if you think about how an option works, the payoff, it's not just the price that determines the value of option. It also is like the time to expire. If you think about, if I want to get an option for Bitcoin in 1 day versus a Bitcoin in 1 year, the one in a year is going to be worth much more, right? Because I have that like optionality over a period of time. And the price that I pay is also dependent on the implied volatility, right? So if I wanted to buy an option for something that doesn't move at all, like maybe USD, it's not going to cost me much, versus like Bera or like XPL, they probably wouldn't even sell me that, right? So yeah, the kind of core concept is that these tools are being used to trade the underlying price, but they come with a lot of like different things that actually influence the price. And if you look towards crypto, what we use for leverage, the perpetual future, is actually just a much more clean, simple delta one way to get exposure. And delta one basically means that the derivative is going to track the price of the underlying one-to-one, right? And it's like a really simple setup. Actually, it's just you have the oracle price, which is the underlying, and you have the mark price, which is basically this exchange futures traded product that you kind of try to anchor the mark price to the oracle, and you do that with a funding rate, right? So when this trades above the underlying price, it's expensive. The longs have to pay a premium, and when it's below, whoever is on the short side has to pay, right? And then you kind of incentivize the market makers to come in, and they can be delta neutral. They can go long here and short here, and basically capture that spread.
One thing I guess I want to add here is like, I think this idea of options are not. I think this idea of if you put perpetuals versus options in front of retail is going to prefer perpetuals is something that is being said a lot, but I don't think a lot of people understand why. And like you gave some very good points, is that options are very complex instruments, but they're the only available instruments within TradFi to get that leverage and that itch for speculation fixed. I would say crypto is very much a retail dominated market. And given that perpetuals have found clear product market fit as opposed to options. Options have been tried a lot of times within crypto. I think it's kind of interesting because it feels like options within crypto would probably only work for institutions and like really smart investors, as opposed to retail who just prefer. It's just so much easier. Slide it to the right, 50x, 80x, figure it out that way, as opposed to options. Please continue.
No, I mean, you're exactly right. Like, another thing about just it being a delta one exposure, it's so much more simple for the average retail participant, right? Like a BTC perp should have the same value as one BTC as the underlying. Like if you think like even if you're retail, you want to kind of like hedge your exposure, it's much easier to just go short 20% of your BTC position to like hedge some of that risk than to like buy an option which allows you to sell, right? Like these things are just much more simple in crypto. But even on the TradFi side, like I know you said, like for institutions, options do make a lot of sense. And it's true, like they do offer you a lot of optionality with the different things that are being priced. But the thing is, like, if you don't want that, you're still paying for it when you buy the option, right? So if you just want the price exposure, perps are probably better. And I think like we'll probably get into this more, but TradFi already has a lot of volume from retail. Like before I started researching, I would assume like the majority is just going to be institutions trading in big clips. But I think it's like 61% of options volume come from retail
Wow.
on the SPX. So they're like driving the majority of the volume. So it is like.
Go ahead.
No, I was
Please.
basically done. I was just going to say it's a big market.
Yeah, it is a big. I remember reading this like Barclays thing back in 21, 22, and they were talking about how retail trading volume has increased so significantly that they're actually like a relevant player right now. Well, relevant's kind of a weird word there, but you get what I mean. I guess let's talk about equity perpetuals. It's interesting to retail, but it doesn't seem something. So I think like part of the reason why people aren't particularly excited about equity perpetuals is because if you're an investor, you don't really want to hold perpetuals. They're not a great way to invest. Like they're a great way to speculate in the short term or in the long or in like the medium term, but they're not a great way to invest in something. So I guess like what do you think about that? Do you think this will only be a retail thing, or like my main point here is funding rates are, at least in the early days, I haven't checked them out recently, but like they were pretty abnormal. Is that still the case? I'm talking about Hyperliquid.
Yeah, no. So the thing is, they are pretty high, like substantially high, and it comes down to like why do you hold perpetual position, right? Like I would say for the majority of people that want to hold stocks, tokenized stocks is probably way better, right? Because if you would like hold something for a long time horizon, like more than a year, it makes almost 0 cents to pay that funding rate. But the thing is, like if you do want short-term exposure, then you think like the cost of this position is your funding rate, and that does fluctuate. And the reason it fluctuates is because of the structure of a perp, right? You have this mark price and you have the oracle price, and you need to incentivize market makers to like fill this gap. And unless you give them a high enough incentive, especially in like these new emerging markets that are pretty hard to make markets for, they're not going to do it. But like this is something that is gonna decrease over time, right? Like we're just getting started with the equity perps. Funding rate is expensive, but over like a longer time horizon, you'd probably guess like what's more expensive, the funding rate to hold a perp position or the premium that you pay for an option, right? Because that's the cost of an option. Like comparing these two things.
Do you think it would help, or I guess what do you see as timeline here for like spot equities on Hyperliquid, for example, to maybe as like an alleviation to these markets in terms of like if you're going long or short the equity perp right now, you know, kind of like hedging out that trade or like capturing maybe a dislocation in the price to the spot market it's not like directly feasible on the app today. But we know that, you know, like you mentioned, there are some small-ish kind of like spot equity token offerings now. Do you think that's something that kind of like helps compound growth in the category?
Yeah, 100%. I mean, like one of the difficulties with making markets for equities is just like proximity to capital, right? If you're making markets for a BTC per position and you need to like adjust one leg of the trade, you can easily like bridge your spot to Hyperliquid, you fill up your margin, right? And you adjust your position. But if your second leg is on a TradFi venue and it's Saturday or Sunday, how do you adjust the position, right? So there is an argument to be made that maybe in the like right now we're using the Oracle price as basically the underlying stock, with on the weekends we'll use internal pricing on the exchanges, right? But you can make the argument that in the future, instead of referencing this TradFi stock, you can just reference the actual tokenized spot on crypto, right? Like tokenized stock, and then market making becomes much easier. It's basically the same thing as you'd market make any crypto asset, right?
Yes, there are. Now, I don't understand this as well as you do, Shaunda, so please correct me as I am wrong. But if you think about it in this way, a lot of pricing on exchanges still kind of relies on Binance oracles, right? Because that is the most liquid venue. Now, I don't know at what point we can get to a point where we can use tokenized stock spot volumes on weekends. Now, I think this is the biggest issue. I think everybody also thinks like this. Holidays and weekends are the biggest issue with tokenized stock trading, especially specifically with Perps, right? Because you have nothing to base it off of, so the entire thing just becomes you have to widen spreads and hold less inventory and just make sure that you survive the weekend or the holidays, right? So that you're not getting. It's the market maker's job to manage risk at that point, and it's very difficult. So they have to they can't make the user get as good fills as possible. This is Jakob showed me this Perps exchange, equity Perps exchange. I'm using it, and it's all the weekend, and takes a 1% fee off me. I'm like, what the fuck is happening? And on volume, 1% fee, but it makes sense because they can't justify anything else. Like they have to. It's either me or them, and they're always gonna make it me. It makes the most sense for them.
Yeah, I'm curious maybe what you think, and I don't know if you get into this in more detail later on in the report or some of your ideas, but obviously like a clear angle here is that these offerings are something of like a regulation arb, a regulatory arb, at least within the US specifically. Like you can't have perps on single names or anything like that for retail or like offer that kind of like commercially. Those are typically like OTC. There's like OTC markets where you could do certain things like this, but it's not a wide thing that you could offer up to a retail platform. I'm wondering like to what extent you think this like continues and can compound for this category, or the progress that we're seeing on the like you see platforms like Robinhood and the stock exchanges start talking about we're going to eventually move to 24/7 trading of stocks. We're going to eventually start talking about weekends. Like, you know, you've got earlier morning hours, you've got overnight hours on like Hood trading of stocks. They have some of the same issues there, right? Spreads widen out. There's less volume. There's less liquidity. And so you're going to get quoted probably like a higher price or like a much larger spread to trade during those time periods. But I don't know, I guess I'm just curious, like, is this something that's, you know, durable, worth going after, and like can compound despite, you know, maybe the real like squeeze is only going to come once the regulation comes into play and says like, okay, perps are cool, and then the big players jump in.
I'm gonna say one thing here. Regulation over the past month, if you see any headline, it's mostly the SEC saying, yeah, we're gonna bring tokenizing everything. So I can't imagine that they're gonna. It's very difficult, right? Because it's the current administration. You don't know what's gonna happen in the next administration. Although Alana, you remember when we talked to her, Danny, and she was very clear that it was what was was it the Clarity Act or was it the stablecoin one? One of the other, or maybe both. They were both like bipartisan supported. So it seems like in general, both the Democrats and the Republicans are very happy. I don't understand enough about politics, but
maybe I'm asking the question. Maybe the better question that I want to ask is like, is this actually a solvable problem, or does it even need to be? Or regulation will come in, and then the bigger venues that exist will say, okay, everything's tokenized 24/7. We didn't need to solve like how to trade these things on the weekend anyway.
One last thing I will say here, and then Jakob, you can take your answer. When you say the weekend, they'll just bring it in. They're bringing it in through crypto, like through onchain. It's not like it's going to happen on the Robinhood exchange the way that they do it right now and then come into crypto. It's more like they're going to be using. This is my understanding of like specifically. I think Galaxy and Solana. Like they had a massive thing about this weekend, right? And they're like, we're going to issue stocks on Solana. So I think they're more so relying on blockchains as opposed to saying we'll fix it on off-chain and then on-chain will adapt. It's more like we're going to use on-chain to fix off-chain. I don't know. This is my understanding based on every conversation that I've seen, but once again, I'm not product side at any of these venues, so I can't really speak too much on it. Shaunda, we invited you to chat about it.
Yeah.
So
No, I like hearing your view, Bog. Thanks for sharing. I guess I'll kind of like phrase the questions like, is regulation a blocker? Is this going to make it worth solving, right? And I think the argument can be made that regulation is actually positive for crypto, for decentralized protocols, because it kind of like blocks these incumbents, Coinbase, Robinhood, from just going in and like capturing the entire market. And I kind of like bring it back to, if you think about futures and commodities, with like BTC Perp that just got approved for US retail, right, on Coinbase. And the reason is that any future with the expiry that's more than 28 days is classified as a future, and it needs like a lot of protection for retail. And the way that like TradFi works with crypto, we're used to exchanges being this fully integrated stack, right? Like, so Binance does everything from user acquisition to holding the collateral to listing the markets to like even performing liquidations. But in TradFi, they've split this into three different levels. You have these brokers that route order flow to markets, and then you have the clearing houses at the back that make sure that everything gets settled. So if you want to get a perp listed on your platform that's compliant, you'll need all these three levels to kind of cooperate with you. It's not a simple decision of Binance just listing their own market, right? How it is in crypto. And we've seen that for commodities, this has just been kind of like the green light has been given. Even then, they've had to make modifications. So, like, if you look at the Coinbase perp, it has a 5-year expiry, something like that. So they've still had to modify this, and we've had this for like years, right? Perpetual futures in crypto has been the dominant way of trading. And now if you go a step forward and say, okay, that's for commodities, will this work for equities, which are securities? The answer is even more complicated, and it seems like it's going to take years for a compliant equity perp to be kind of pushed by these platforms. So in that meantime, DeFi has the opportunity to like offshore this flow. There's a lot of flow coming from Asia, from Europe, European retail that you can kind of like take. And also you have decentralized front ends with builders. So to enforce the regulation also becomes much more difficult. So in that sense, it's kind of a window of opportunity to take advantage.
Very good. And when they catch up to this, we'll figure something else out. It'll be fine. Shaunda, can you give me a gentle introduction overview to the landscape right now? It's HIP3, obviously. I think they do the majority of volume. What else is there?
Yeah, so it's HIP3, which Hyperliquid has kind of outsourced to third parties. Trade XYZ is by the same team as Unit. Unit is basically the tokenization layer for Hyperliquid that does UBTC, UETH. They're handling all of this. And so obviously they have an advantage, and I think they're dominating right now, doing around like at least 95% of Hyperliquid's equities volumes. Then you have Felix. Felix is a Hyper EVM native ecosystem projects. They built like a ton of tooling solutions for Hyperliquid. They built the CDP lending platform, and now they've built the equity perps. And as I said before, if you think about how do these platforms differentiate, it's not much differentiation, right? Everything's on Hyperliquid's front end. Felix is differentiating because it is a aligned stable coin. It's denominated with USDH, which means that it gets these fee trading discounts and rebates. And that is probably going to be more significant in the future because right now they have this growth mode, right? And the growth mode reduces fees by 90%. So these like marginal decreases from USDH to USDC doesn't matter much. But in the future, that's going to be like the core differentiator on Hyperliquid. I think Venturals also just listed their own kind of index product, like top 7 tech companies. So that's Hyperliquid there. And then you have Ostium. Ostium is doing kind of like a different model. It's not a order book model. It's more like a peer-to-pool platform, and that comes like with its own set of trade-offs. So for Ostium, I think the main benefit is for retail traders. You're executing. Yeah, thanks for pulling that up. you're executing against the Oracle price when you're trading on Ostium. So you're getting TradFi level execution. On Hyperliquid, you're going to have to buy the mark, which you're going to hope that a market maker is like quoting you as accurately to the Oracle price due to the funding rate, right? But here with Ostium, you get direct execution. The trade-offs there is the LP providers do take some directional risk. Like if you look at a chart maybe of the return of the liquidity pool, it's not up only like the HLP. And then so those are like the two different models, like this order book model with Hyperliquid. Ostium is more like peer to pool. Then but and then like, okay, to contextualize this a bit more, like emerging solutions, how are they going to be built? It almost seems like, Bulk, maybe you have some insights here, that Hyperliquid, we kind of know who the winners are going to be. There's not that much more room for new equity deployers to come in, right? Like with Unit and Trade kind of monopolizing it. But there are going to be like ways for different architecture. So Best is another one we covered in the report. They have their own pool that's kind of trading against traders, and they're hedging their exposure off chain, right? So these are like three different approaches.
I guess like I wanna kind of add in one thing here. You mentioned venturals. How does that work? That's not gonna work. Private markets. I know this. We're talking equity perps here, but
dude, the funny thing is, I don't watch this podcast that often, but I feel like every single time I watched it, it's something to do with you hating on venturals.
Well, I really like. Okay, first of all, I maybe said this right. I have nothing against venturals. I think it is a very cool idea. That is, it's a very cool idea, and it's like objectively one of the right things for crypto to head into is to make these very illiquid markets liquid. I guess I don't hate on it. I'm just relatively ignorant about it. I need to understand a bit how they are able to price these things based on. Did you see Luke Cannon talk about it? And he had a long on venturals and he lost all his money because the markets are so liquid and these prices move ridiculously.
Skill issue.
Yeah, I feel like the question here for me with venturals is like, I don't know if this is people are just too excited to make a perp of everything, because in my view, like you don't really have, there's not a liquid spot market for these things today in the first place. And the way that privates work is that they go up over time, right? They raise at a valuation and then 3 years later they raise at a higher valuation, and like nothing really happens in between that. And there's not really like much public pricing or like trading happening. Like, there might be some OTC kind of sales here and there, but like there's really not much going on that would make sense to do anything other than just like be long it. But does being long a perp when the timeline to like the next valuation bump is like 3 years out make sense in the first place? I think that's kind of the question. It's like, is it even the right tool for this market?
Yeah, I mean, with pre-markets, you kind of look at the issues that tokenized equities, perpetual equities have, and they're kind of made like 10 times harder to solve, right? I mean, it's the same thing. You have the problem for equities that you have one leg on TradFi, one leg in Hyperliquid, and then for pre-markets, you have the trade-off that you have one leg that's private, unlocked, you can't hedge it. So the way you try to solve this is, again, you have higher funding rates to try to make
and massive spreads.
Yeah, you have higher funding rates to kind of incentivize someone to arbit back down. But then the question is it even worth to go long if you're paying like 50% a year, unless you're trying to trade news or some
that's the only
event,
thing it works
which
for.
and the interesting thing is, I was like looking, I think Anthropic had a recent announcement, and I was looking at the chart on venturals, and I felt like it didn't actually react the way that I would have expected to at all. And another reason is that 50% of the pricing comes actually from the internal price, right? So it's 50% taken from estimates of the company, and the other 50% is just trading on Hyperliquid itself.
Okay, one last thing here is, God forgive me for saying this, but is prediction markets a better way to bet on IPO stuff? Because it's very clearly a yes or no thing versus, like you said, you could have taken a position on Anthropic on Perps, but it might not do what you expect it to do. But I guess that's how it works in regular markets as well. I don't think prediction markets are a good way to bet on things, but one other thing I was reading about is that actually these private company trades are becoming a lot more like liquid compared to previously. So maybe like as that becomes increasingly a thing, maybe the perps catch up. I now feel bad because I can remember another time I spoke badly of Ventures. It's not that I mean ill on the Ventures team. I think they're coming out with a very cool thing. It's just I'm ignorant and I don't quite understand how it's supposed to work given how illiquid these things are. I don't even know how you would do the pricing. It seems absurdly complicated to me. Let's do you think, Jakob, the bear case for Hyperliquid is that they've outsourced equity perps and to an extent spot asset deployments to third-party teams? The correct answer here is yes, but up to you what you choose.
I mean, I would say the correct answer depends on, did they trust the right third-party teams to do it, right? I mean, until now, it seems like Unit is doing everything right. It seems like Unit is using all of their revenues to buy back Hype, just like the assistance fund. Like, logically, of course, you say Hyperliquid was giving away 50% of their revenue, right? Because that's essentially what they're doing. But if that revenue that they're giving away is being used in the exact same way that the assistance fund would use it, it's not really a problem.
How does that scale, I guess, would be my question. Is you let someone else go and do it and they say, okay, and we'll take some of the revenue, but then they use all the revenue to then buy the asset. Like how do they continue to operate? Or are they just doing this out of their own goodwill and they own a lot of the asset and that's enough for them?
I imagine they'll at some point start taking a cut out of it. It's the same as like what you expect Hyperliquid to do eventually, right? Like I imagine eventually they're going to be making, I don't know what they make, right? Let's say 2 mil a day buybacks right now. Let's say, is there a funny comment?
Yeah. don't read that. Sorry, don't read that. I reacted too strongly.
Like Hyperliquid right now buys back 98%. Eventually, 99%, eventually if it's making like 5 mil a day, then they can probably start taking like 200K, 300K a day off instead to be used as like building up a treasury and stuff. Like the assistance fund right now is like, the main point here is like, I imagine Unit or like Trade XYZ will also eventually start doing this, right? Like they're right now buying back Hype with all of the revenue. Maybe in the future they only buy it back with 90%. And then when I imagine they're VC backed or Shoku's extremely rich and he's just funding the whole thing by himself. So they'll figure something out. I would say it's more scalable than a single team doing it. It's just kind of worrying if the team wasn't good. I agree with Shaunda, and this is kind of my way of like, because I knew what his answer was going to be, so I'm trying to play devil's advocate while still making Hyperliquid look good.
What about the other question? Like, are the buybacks up to today a mistake? Like, should they already be making the transition then to using some of the Unit or Hype to then fund additional operations or expansion?
Buybacks are good because it's the only way to express. Currently, it's the only way to express that the token accrues the value from the protocol. The only other way is to do very complex legal stuff or give out dividends, which is not possible. So for that, it's good. Should they maybe be doing 95% buybacks instead of 99%? Yeah, I imagine they've thought about that. And I imagine they are thinking about it for the future, if that makes sense.
I'd love both of your takes on this because my thought is I think the buyback could be any number. It could be 50% even, as long as the rest of those revenues, there were clear communications of, hey, we're going to spend 10 million a year to make this product and make this product better. You know what I mean? I think to your point, up to this point, there's been no clear separation of these things of like, okay, the labs team just makes all the money and like maybe they build out the better product or maybe they don't and they just get big fat salaries. But I guess I'm wondering, could you just have some more clear communications of, you know, a case of like a unit of this is what we're building out. We're going to spend 5 mil to build this, but 75% of the revenues will still just go straight back into the token. Do we have to move in that direction, or can we buy back in all the money forever?
This is my personal opinion. I think the entire like 100% buyback thing is objectively not the most efficient thing you can do with your revenues, or the fees that you generate as a protocol. But within crypto, we move so drastically between these like wavelengths of you have nothing, you have everything. Like imagine a year ago, we had this revival of what people like to refer to as a revenue meta, and then everyone was like, oh, unless like something has revenue, I can't buy it. And like we overcorrect a lot. So I think this is probably an overcorrection, because historically none of the protocols made any money, and the protocols that made money just kept it in the labs team, or just took it as salaries. It's an overcorrection. I think going into the future, teams will be more transparent and start spending 70% on buybacks or dividends or whatever comes up in the future, and 30% maybe on mergers or acquisitions or new product lines, etc. We'll get increasingly sophisticated with, I think, how we do protocol balance sheets and etc. I think that's the future. Is like right now we have an overcorrection and then it'll correct back into like a middling thing. It is a bit much to buy back 99% of the token. Like they couldn't save 3-4%, build up an insurance fund. I don't know, buyout. What? Why are you doing that face? It's my podcast, buddy. You can't do that face on my podcast.
Shaunda, what do you think? Do you have a strong opinion here?
Well, I think the buybacks are symbolic, right? Like,
yeah,
I think that was also why there's such a debate about when there was like the proposal to take a portion of it and redistribute it to hyper EVM projects. It's like this large buyback amount symbolizes that exactly that. It symbolizes that the token is the priority of the protocol. Like there's no equity, there's nothing else. All the value is going to flow back. And I think more than that, it kind of highlights the model of how Hyperliquid operates. And I'm not going to say that this is the perfect model, but the way they like coordinate with basically their token and their incentives, it means that they don't have to pay people to do stuff, right? Like all their listings they didn't pay for, all the integrations they didn't pay for. They want to align stablecoin. They made a proposal. People were willing to like give them millions of dollars, right? Just to have like the USDH ticker. So I think it's just a new way of doing things where you don't need to take revenue. You don't need to pay people. And
completely agreed. The builder codes and HIP free work perfectly for it. For like, I think it's much more scalable than what other teams might want to do, because you essentially give people the ability to make money using your tech, and make lots of money using your tech. Like some of these builder codes have made millions of dollars a month just off of like a simple integration. One thing on this buybacks thing is, if Hyperliquid comes out next month and says, look, we want to expand the amount of FX we're offering. We don't want to outsource it. We want to do it internally. Therefore, we're going to cut down the buybacks from 99% to 96% over the next 3 months. We expect that this will generate around $80 million, and we want to spend this on like over the next year to build out XYZ. That is completely rational because they're also saying what they want to do. But this isn't how it works in crypto. Like to Shaunda's point, if you don't accrue all value to the token, people assume that you're doing the wrong thing, taking luxurious vacations, buying property in Sardinia, etc., etc. So you have to do the buybacks. And I think if any team was to say, we're not going to be doing full buybacks, we're going to cut down a bit, specifically for growth through XYZ, it would be Hyperliquid. I'm just not sure if they need to do it. I'm not sure how they're going to do it, but it seems like their focus is allowing other people to make money through them and build out interesting new verticals, which has worked for them so far. I don't know if you can say that about any other team that can plug into this like liquidity thing and make everything work. It's very difficult building out order books. Like past few days have been Tarun and Dan going against each other. Dan Robinson. I don't know why I call him Dan. Like we went to high school together. Dan Robinson arguing with the founder of Paradox. I can't remember his name. Fiddy BPS. And like Jeff dunking on everybody. It's very difficult to build order books. So like if there's one that works and it's popular and people pay money to use it, then that's the best way to like onboard new products onto your platform. Agree or disagree? Agree. All right, last few questions.
Before we get to our last few questions, Boccaccio, I want to do a quick shout out to our sponsor for today's stream, Uniswap Labs. Thank you to Uniswap for sponsoring today's stream. The Uniswap trading API solves the problem of adding crypto to your products without the hassle of needing deep crypto expertise, ongoing maintenance, or liquidity aggregation. The trading API provides access to the Uniswap protocol, which has processed 3.3 trillion in all-time volume, handled over 465 million swaps from more than 25 million addresses, all with zero security breaches. Developed by Uniswap Labs, the US-based team behind one of the most used DeFi apps access some of the deepest liquidity in crypto, combining both on-chain and off-chain sources for optimal pricing. The same liquidity that powers billions in swaps, now available via a singular API. Thank you so much, Uniswap. Get right back to it. That's weird.
Right.
There we go.
This is my next question. There's one more, but I'm waiting for it to show up. The comments show up a bit late. Danny, do you have any other questions? I feel like I've been dominating, so I'm going to lean on you before I ask my next one.
You got me out of the, you caught me there in a, I guess I was gonna maybe ask on that, to that last point around, I mean, you said, and you guys kind of agreed that you think that strategy is correct in terms of just starting to let other people build on top, becoming like this platform. I'm curious, like, to what extent there is maybe a middle or like some line to draw in the middle of that, in terms of, in some cases, maybe building your own products. Like maybe that's putting native, borrow lend onto Hypercore. And then in some other respects, it's like, okay, go ahead, build your own front ends and integrate with Hyperliquid, and we got the builder codes, and that's cool. Like, how do you balance those? How do you weigh those in your mind? Do you think there's a point at which it's like, okay, all product development now happens through other people building out stuff on Hyper EVM, or like, okay, no, we're actually going to put, we're going to build our own borrow lend. We're going to build our own additional leverage capabilities. We'll build other products on top of the actual base Hypercore product stack. Because there's some inherent competition there, right?
Shaunda, you can take it.
Thanks. Yeah, I mean, I think where you draw the line of what does Hyperliquid do and what they outsource, I think they're pretty focused on just building out the core infrastructure. So the order books, the matching engine, anything that is like to do with infrastructure, like the borrow lend, unified margin, cross collateral, they're going to handle that. And then in terms of distributing this infrastructure, I think they're basically outsourcing that completely, right? The builders are doing the consumer layer. They're focused on like this user acquisition, bringing new retail flow. And then you have the deployers that are spending their time thinking, how do we best allocate these markets, be it equities, be it pre-markets, be it like Pokemon cards.
I think you have to outsource because it's the most efficient way to scale. I don't think you can. Like Lighter is doing a fantastic job right now of launching products fully in-house. They are doing a great job. It's a good platform. I've used Lighter, but because they are presumably working on building out an equity perps platform, they're building out a spot platform, and they're offering regular perps and they're offering FX. This made Lighter offer equity perps, but it's only tradable 9 to 5, which isn't like a very like it's still great, but it's not a very useful thing. Like if you want to speculate 24/7 ideally, and if you offboard that risk management, like the main thing with perps or like equity perps in general is the risk management aspect. It's not actually deploying it. It's like the pricing, the oracle, and the making of the markets. So you can't do this all in-house, so it makes sense to make others build it out. Now, the good thing with Hyperliquid is that I don't know if other teams would be able to onboard enough interesting, smart people to build this out for them. But they have that advantage compared to others. I'm sure Lighter would have been able to, but like DYDX wouldn't have been able to in its heyday. I don't think so. But it's the truth. I have nothing against DYDX. I loved it back in the day, but I don't think they would have been able to do it in their heyday. Versus now, because they can monetize it very efficiently, up to 50%. It is also kind of saying how heavy everybody involved within the Hyperliquid ecosystems, like hype bags, must be, that these guys are choosing, instead of making millions of dollars, they're like, yeah, we're just gonna ship it into hype. I can't think of one other ecosystem where it's like you're being onboarded for liquidity. Like, no, you're building out a distribution channel on top of this product, making massive amounts of revenue off it, and you're like, yeah, I'm just going to ship it back into the product. I don't know. It's quite like, it's a very interesting case study. It hasn't done very well over the past month, which is something I'm going to talk to Jim and Dougie from Figment about. They hate Hyperliquid, so I want to see their opinions on it, but it's going to be cool. I jumped off like 3 things over there, but I think my general point still stands.
Yeah, maybe going back to the kind of the front end or like the interface piece of it. Like, I guess, Shaunda, you're pretty convinced of this, like, export the distribution piece to other players. Does that mean there's a point here where they, Hyperliquid kind of team stops sort of caring about their own front end offering, or is it always like a both streets kind of angle? Like, you offer some meaningfully competitive front end of your own on top of your tech stack, as well as, you're kind of exporting it to others. I feel like this is what you see with, I don't know, a lot of teams take this route. Like Kolshi is an example where they kind of exported some of their stuff to Robinhood for more growth and distribution, but of course they have their own app.
Yeah, I think I have pretty strong views here. So firstly, maintaining the front end is essential for Hyperliquid, because that's where you can monetize the users most effectively, and that's where you can retain them, right? So this idea of being kind of the infrastructure layer for all markets worked really well with their builder codes, because for the first time, front ends could easily monetize perp flow through their platform, right? You think about Axiom, you think about Phantom, you think about Rabby, like all these wallets that integrate them already monetized user spot volume, right? Through aggregators. Now Hyperliquid enabled them for the first time to offer perps as well as a product without having to build the infrastructure, which would be extremely complex. It would take them time to get liquidity, right? And because they provided the solution, you saw a lot of adoption from these front ends, right? And I think now the statistic is that 50% of users traded on Hyperliquid come from these front ends. And so far, because Hyperliquid is the only one with builder codes, it's worked really well for them. But if we are to look at what these front ends actually are, they just aggregate various sources to get the best quote for their users, right? Like you think about Rabby, you think about Phantom. A user that swaps through Phantom is going to aggregate the best spot route through different dexes, through Radium, through Orca, and get them the best quote. And there's a question is, can that happen to Hyperliquid? Can it be that this thing which gave them exclusive flow from retail actually becomes commoditized, where they just need to compete with other perps for like who can offer the best code? And when you have that, you have all your pricing powers kind of stripped away from you, right? You don't own the end user. The end user is interacting with you from an interface of their choosing, like Phantom. Now, if Phantom decides to route through the best exchange and Lighter, for example, offers lower fees, you lose all your flow just like that, right? So that's kind of the risk going forward. Will there be much more competition, and will these builder codes turn more into aggregation, which we saw on Solana ended up that the dexes, which were kind of the back end, had much lower valuations and revenues than the front ends. Like I think I wrote about this in the report, but these front end terminals that route through dexes make 3 times the revenue than the dexes themselves. And I've seen a few dexes now offer builder codes. And that's one of the concerns going forward, that this just becomes commoditized and that Hyperliquid loses its pricing power. So for that reason, they need to think about how they're going to handle this, and also like maintaining their front end is a priority.
And I think they realize this as well, and they realize that they can't be sending a lot of people to like different HIP-free front ends. So they decided on, I think it was a last minute decision, although I don't know, but they decided on hosting everything in the single front end, right? Like it's all under the Hyperliquid front end.
Yeah.
And they'll do like strict. One of the big worries here is like with HIP-free specifically, liquidity fragmentation. Like you can long Tesla USDC or you can long Tesla USDH. Now, technically you should long USDH probably because the fees are lower, but like the different providers have different risk metrics, different oracles. It gets different leverage as well. I think Felix only offers 3x and Trade XYZ offers 10x. So there's some differentiation, but it is at the end of the day leading to some liquidity fragmentation, and I'm not sure if that's like going to be a cause for concern at the front end level. They've priced HIP-free, I think, good enough such that not everybody can get involved and launch random perps exits with random quote assets. So hopefully that keeps the bar high, but go ahead.
Yeah, I was wondering about, when you talk about the pricing, what are your views on HIP-3? I mean, now they've reduced 90%, but without that fee reduction, because you're paying Hyperliquid fees and HIP-3 fees, you're paying like double, so like 9 basis points on volume, which I feel like is pretty high. Because then if you think about flows coming from a builder, you take the builder code plus HIP-3 plus Hyperliquid.
You're paying 3x the fees, right? In that case.
Yeah.
I don't have very strong views on this. I do think the equity perps are probably not at the most efficient state right now, purely because on top of like, if you're longing, first of all, you should not be doing this, but if you're using Phantom on mobile, longing equity perps previously to the 90%, you were paying 3x fees, and also you're paying horrible funding. So it's not at their best state, and I think it's like a 3 to 6 month development period, and I think that's why they implemented growth mode. I also wouldn't be surprised if Hyperliquid eventually reduced fees to an extent, or maybe like took half fees on. The like argument that a lot of people make is, if Lighter's coming in with 0% fees, how's Hyperliquid going to compete? I don't think they have to go to 0% fees, because then there's a different trade-off to be made there. But I think eventually they might have to come up with some form of a solution. Like it's not sustainable, the free X fees. Maybe you never long equity perps using builder codes, and maybe that's the way that you do it. Or maybe you have to ask HIP-free implementers to cut down fees themselves so that you can take the full fee. Or if it's unit, you can cut down your fees to 0%, and you like Trade XYZ does the full fees, and since Trade XYZ just ends up buying back Hype anyway, it's virtually the same thing, except you're not double charging on fees. There's a bunch of things they can do that. I don't know what they will do, but the 90% growth mode makes sense for the time being. I'm wondering if it'll be a permanent thing.
Dude, I mean, I think this is also going to be funny. If you check out my model that I made, maybe Dan, you can pull it up on like projecting Hyperliquid revenues from equities. I've also just said like the base case is probably that they cut fees in half. I think 9 basis points is too much.
Danny, are you pulling it up?
Yeah, I'm looking for it.
It's very difficult for Danny sometimes because he's not part of Blockworks Research anymore, so we cut off his subscription.
Well, Shaunda did a very nice thing by writing a 10,000 word report, but that also means it's very long. Very long.
Wait, it's a tweet. I'll send it to you.
Oh, okay. If it's a tweet, then shoot that over. The one thing I would say, here's what I would say is, and you know who actually likes to say this is Ryan Connor, but I agree with him on this one to a large extent, is that users are not like perfectly price sensitive. And we've had this conversation many times over. We talked about trading terminals and front ends, like over in the meme coin space for a long time, about like these guys are just all going to compete each other to zero fees, and like that's not what's happened. Now, of course, the rates have come down. Let me pull this up for you while we talk about this. The rates have come down on those products and they've become like more competitive, but I think there's kind of like an end stater argument that likes to creep its way into these discussions every single time. And it's like, okay, is everyone just going to have to lower all their fees to zero and then nobody makes money? And then it's like pointless. Why are we discussing it? It's like, no, that's not how things work in practice. Not every marginal user immediately switches to the newest product that has a lower fee. It just doesn't work like that. There's brand loyalty. There's security. You feel safe with the product. You just like the product. You just like the brand. You like the team. You're already locked into the ecosystem. A lot of various factors. So, but take it away, Shaunda, this analysis. I'm curious. You said you kind of project them having to lower their fees anyway, which probably makes sense. There's probably still some kind of gradual decline.
One funny thing I will say here is Shaunda posted this at like 4 a.m. Eastern time, and then was like, hey, why am I not getting any likes? And then he had to delete it and repost it. Please continue, Shaunda.
Yeah. No, I mean, I think this is just a pretty good overview because firstly, yeah, it shows that I guess I do expect prices need to come down for it to remain competitive. But I think like just to tie everything together about equities, why this is so exciting is just to highlight really the scale of how big this market is. And even if you capture just a small fraction of it, how profitable it can be, right? I mean, the problem with DEXs, with centralized exchanges, if you're only trading crypto, the majority of your volume comes from BTC and ETH. I think it's around 80%. It's hard to grow beyond that. Like, yes, there are new tokens. Yes, there's demand for those tokens, but it's not material compared to these like liquid blue chip assets that people are trading. And if you compare the market size of crypto, which I think traded around 1.6 trillion in November, equities traded around, I'm reading here, 86, right? So it's a huge market. And I think even if you can just capture less than 1%, like 0.5%, at even half the fees that Hyperliquid has at 4 basis points, I think if you go to the next slide, you see Hyperliquid will like 3x its revenues.
Wow, this is great. But I also just realized that we can't be doing pods with tweets of models on the screen because it's impossible for me to read. I can't imagine being a listener and be like, what the fuck are these guys talking about?
There you go. Annualized revenue projections.
So annualized is 2 bill off of equity perps?
Yeah, if they capture 0.5% of November's notional volume at 4 basis points, it's 2 billion analyzed.
That's pretty good. That's pretty good. I expect that. I'm a bit worried that competitors will ship faster in terms of equity perps because of like just velocity, but I think we'll see. I expect Hyperliquid to perform well with equity perps becoming more and more popular. I expect that. We were a bit late to equity perps and tokenized stocks. Maybe this will be a good way to wrap this up. I expect that we were late. Private credit was very popular, and then that instruments became more popular, tokenized. I expect that the next thing makes sense, that it's tokenized equity and perps, equity perps. I don't know if we're there yet for private equity, but private equity doesn't sound right. Pre-IPO is what Ryan Connor likes it when we use. I expect we're a bit early, but it'll come. The entire financial world will be tokenized, and I expect that, at least in the near future, a decent chunk of it will flow through Hyperliquid. Any disagreements here? Danny holds no hype, so he might be disagreeing.
Yeah, maybe what I'll say is a relatively neutral party here. I still think the story for Hyperliquid is very promising. Like we've discussed, you can see the competition growing because I think basically everyone recognizes the large revenue opportunity here in the space. And so what I would say is, like, I think Lighter has a pretty compelling offering today, and like their strategy, their growth strategy, and like the way that they've been kind of shipping and offering new features has been pretty promising, as well as I think they're like their chosen model of taking a bit of like a Robinhood style approach to, you know, don't charge retail fees on their trades, and, you know, work out something kind of behind the scenes with market makers, or charge more for, you know, enhanced latency access to the exchange. I think something of that nature, right?
We lost him. He was saying something really good as well about Hyperliquid. Okay, Shaunda, it's just me and you in the last moments. Is there anything else you want to tell the listeners as we end this beautiful podcast episode?
Yeah, I mean, I don't want to self-shill or anything, but I've tried to cover the equity perps landscape report that I've done as best as I could. Huh?
Go. Yeah, guys, make sure to follow Shaunda on Twitter. His @ is Shaunda Devens.
Yeah, and specifically check out the article that I wrote, right? This thread goes over everything, the market opportunity, the current players, and basically the architectural designs as well.
Yeah.
And the full report is on Blockworks Research.
Woo! Okay, well, Jakob, Shaunda, this was a pleasure. As our last question, I want to ask you, why did you, as a 6'5" boy, pick the name Shaunda Devens as your username?
They silenced me. They tried to silence me.
There was a time before when I was more of a schizo milady Discord guy. Never thought of being doxxed, and I guess I just stuck with the name. Good.
Okay. Fantastic. Okay, Danny, we already covered the final words, but I think we're good. To our listeners, thank you again for listening to us. Yep, I know that we're getting close to the holiday season, so we're getting less and less views. It's very important that that doesn't happen. So even if you're with family, make sure that they all put it on their phone and listen. You can turn the volume down fully, but it helps pay for Danny's dogs. He's going to get 6 more.
Volume at 1%. Open up 39 tabs on every device you own in your whole family.
Figure it out.
Let's get those view numbers up.
Peace.
Thanks for listening.
Having me, guys.